Good morning, everyone. Welcome to the 9th webinar of Business Markers. This webinar is in English. If you want to view the Dutch version of this morning, you can ask for a replay on our website. The webinar will last about 45 minutes. After the session, we have provided 15 minutes to answer your questions. And now I will give the floor to our guest speakers, Serge van Eyck and Wim Braakman.
Welcome in this beautiful studio from AB Sound in Belgium. And today we will talk about how finance and business should work together. And we say should work together because when we look at it at the moment, we see that the relationship between the business and finance, well, it can be quite hostile. And if the cat is finance and we are the bird, then we better not be a bird to the cat. And when we look at why businesses fail today, and we look at the 10 reasons, the most important reasons why this happened, then actually we see that there is a clear link between the failure and finance. And when we talk about a financial plan, and we ask businesses whether they have a business plan, and they don't have a business plan, knowing that a financial plan is part of a business plan, then we wonder how they will be able to manage their targets and how they will be able to reach their final destination. And when we take a closer look at the business and we talk with product marketeers and they work on a product P&L, but they have no discussion with finance, there is no relationship between them and finance, then we wonder how the parameters that they will use to build the P&L, whether the result of the P&L will be realistic or not. And we all, I think, remember what happened with Enron in early 2000. One of the biggest energy companies of the world, they went bust with profit. So that is possible. And today, every day, actually, we have to take decisions. And in some companies, we see that they're quite successful in taking decisions. And in other companies, we see that they're not successful. Is this just good luck? Is this coincidence? No, it's not. It's because the company that is taking, in many cases, good decisions, they're prepared. They have a model. They have a process in place. And that's what we will share with you today. We're going to share models. We're going to share concepts. We will explain you how to do things and to explain you how to avoid these pitfalls in the future. I'm Serge van Eyck. I started my career with the family company Geocard. And then for about 15 years, I joined the Walt Disney Company in sales and marketing roles and general management. And then afterwards, I had a very close look at the media world with DPG Media. Today, I'm one of the Business Markers partners, and I'm actually working on projects for Traxio, MAT, and performance projects. And when we need financial expertise, then, well, we work together with the CFO Center. And that's why we do this webinar together today.
Thank you. Hello, and also from my part, a very warm welcome to this webinar. My name is Wim Braakman. I'm part of the CFO Center. And formerly, I worked for more than 15 years with the big four companies, as for example, PricewaterhouseCoopers, Deloitte, and Anderson. After those 15 years, I moved into the business, sat at the other side of the table, as being a finance director or a general manager of small and medium-sized companies. Since 2017, I joined the CFO Center, and currently I have a portfolio of 8 active clients where I, as a part-time portfolio CFO, help these companies move forward with a financial perspective. Through this webinar, we will make the link more and more, or sometimes with the world of Formula One, because business is like Formula One, and Formula One is finance, so business is finance. We can learn a lot of the Formula One world. They start with a clear plan and adapt every round depending on the situation. They have a team ready in the pit stop to change the wheels, tires, to add fuel to the car, give new orders, etc. because of the fact that they have a lot of figures and data that they monitor online in real time. Today, this webinar is divided in 3 parts, 3 chapters, if I may say. The first one is actually focusing on how to formulate your ambition and plan on 1 page. The second chapter will be focusing more on the role of finance as being a full team member of the company in moving forward towards their strategic goals. And last but not least, we will focus and we will look into the details about how can we have an agile decision-taking process. If you do not know where you are going, you will probably end up somewhere else. Serge already mentioned it. If you don't have a plan, then it is going to be difficult to know where you're going. Traditionally, typically, the budgeting process is something that we are doing year by year in a traditional manner. What we are saying, instead, we recommend to work with a viewpoint several years into the future. Important consequences is that the goals are more ambitious, higher, and it's very well defined where the company wants to be in 3 to 5 years. For example, in the Formula One, we could decide that in 2024, we would like to be world champion in the Formula One competition worldwide. So step away of the traditional sequential budgeting on a yearly basis and work backwards, starting from the ultimate goal set in 2024, becoming world champion in 2024. What we learned from a year like 2020 and also the current year 2021 is that it's very important that we are doing regular reforecasting exercises and that we do scenario planning. How are we going to get in 2024 if some circumstances are going to happen underway? This is an exercise and a process that we see that it's going to that it becomes more and more that we do this in shorter terms, not on a yearly basis, but we will do it on a quarterly basis and even on a monthly basis if needed. Luckily for us, there are Excel spreadsheets that we can use for that, but also business intelligence tools to work with different scenarios and simulate. Afterwards, it is possible to take the sound and good decisions which scenario to follow.
So if we want to build a plan, we have to look at the future and we have to know what our ambition is. So what is our ambition? How will we reach the finish and win? And again, we compare to the race circuit and we see 3 phases. So in the first phase, we're going to formulate the strategy. And then in the second phase, we will have to validate it. And then finally, we have to communicate it, share it with our team, share it with our partners in the business, and implement it. Back to the first part of phase 1. Before we can start formulating a strategy, we have to know what our actual situation is. To do that, there are several ways, several tools to do this research. You will have to know your strengths and your weaknesses, and that's internal. And you will have to look at the market. You will have to know what the opportunities are and what the threats are. And once you know this, you have the basis to start your building your business plan. And we use OGSM as a model, and in one word or in one sentence, it's a business plan on 1 page. Because that's the idea. You have to be able to explain your business plan in a few words. People will have to be able to understand it in a few words. And we will have to make decisions. We can't do it all. You can't be everything for everyone. So back to our plan. The O of OGSM is your objective. And what is an objective? An objective is something you want to achieve. It's your dream, and not tomorrow, but in 3 to 5 years. And you also will have to mention how you will do it, because otherwise it's too vague. Once you have defined your objective, and for instance, as Wim already mentioned, could be we want to be the world champion in the Formula One in 2024, then we're ready to look at our strategies. And the strategies are the building blocks of your objective. What do we need to work on in order to get to the objective? And in our example, this could be the top-notch equipment and technology. Very important in Formula One. If you don't have it, you will lose it. We also know that we all will have to work together as one team, whether it's in the pilot or when changing the tires. We all will have to work as a team, including engineers and so on and so on. A very third important building block is money. Formula One, quite expensive. If we don't have the funding, we will not be able to win the championship. So these are our strategies. Per strategy, we will build an action plan. Projects. What will we do? What will we do per strategy? And at the end, it actually will be our to-do list. If we look at the Formula One example, and we look at the strategy and our funding, then there's several ways to find funding. But we decided to look after sponsorship, to start selling merchandise, and to renegotiate the TV rights. And we will have a target per project. Because if we can't measure it, you can't manage it. Up till now, we only were talking about words. And the red part of the OGSM is all about the numbers, the goals and the measures. And the goals are our KPIs. 4 to 5 KPIs, not more, that we will use to measure if we are still on track, if we still are on track to realize the objective that we defined before. This could be, for instance, the number of golden medals. And it at least will have one financial parameter, probably 2. So that's the KPI dashboard. But of course, we also want to measure the strategies and the projects. And to do that, we will install the performance indicators, the PIs. And per strategy, it's going to be about 4 PIs. And in our example, about sponsors, about merchandise, about TV rights, it's going to be euros. A target per project. All that together is our business plan on one page. And that's our lesson number 1. If in a Formula One you don't know where you're going, well, there's a big chance you will crash. And that's something, of course, you want to avoid. So that brings us to our first question that we have for you. Do you have a clear business plan? And if the answer is positive, then we have our first cup, but we will need 3 of them. The second cup that we would like to get in our hands is finance a full team member? Are they part of the team? Because the race pilot will depend on the numbers. And these numbers will come from the engineers. And they will say like, okay, what's the average speed? How many rounds to go? What if it starts raining? What's the impact on the car? Do they have to change the tires or not? So we will have to control the numbers. But we have to be realistic as well. Not everybody likes numbers. But we have to know, we have to understand that everybody is finance. And we have to understand the impact of the business on finance. And that's a very important topic. And when we say everybody, it's going to be everybody. It's research and development. It's purchase and supply. It's the inventory. It's a production and logistics, also marketing and sales. Actually, everybody, all people engaged. Everybody is finance.
To demonstrate the role of finance, we have drawn up this diagram. Adding value to support the internal customers, such as R&D, purchasing, marketing, sales, production, logistics, etc. It's very important that we have the necessary information and that we can start supporting the business from a business perspective. This is finance level 1, where we look into questions and topics around outsourcing. Do we need to outsource some of the activity? Are we compliant with our reporting? Do we have solid and good banking relationships? And what about tax and fiscal planning and legal issues? To do that, finance is falling back on 3 key financial statements, of which the first balance sheet and the profit and loss statement is actually pulling together the annual accounts. Those are the annual accounts that also will be made publicly once a year. The third one is the cash flow statement. So these 3 key financial statements are the pieces of information of which finance is starting off. If you take a closer look to the balance sheet, it's a financial statement that reports a company's assets, liabilities, and shareholders' equity. The balance sheet is one of the 3 core financial statements used to evaluate the business. The balance sheet is also a snapshot representing the state of the company's finances at a certain date or at a certain point in time. Fundamental analysts use balance sheets in conjunction with other financial statements to calculate the financial ratios. It's traditionally built up by, on the left side, the assets, and on the right side, the liabilities, and we need to be in balance when we produce those figures. If you take a closer look to the second key financial statement that we are using, and which is more in line and more useful to operate the business, it's the profit and loss account or the income statement. Let's build one up. We start off with the turnover, and you see here that we put the figures in for the year 2020 and the year 2021. If we deduct the cost of goods sold of our turnover, then we obtain the gross margin. If we continue to deduct other costs such as marketing and sales, administration and overhead, and also the payroll for our employees, then we come to a very important concept which is called EBITDA. Earnings before interest, taxes, depreciation, and amortization. A very important concept and a very important figure to run the business. If we then deduct depreciations and amortizations of our investment goods, then we come to the operating result. Do we include our financial cost, meaning the interest that we have to pay on our bank loans and even on our leasing contracts? Then we come to a profit before taxation. If we deduct the taxes, we have our bottom line, we've got the net profit. If we have a closer look to what we can do with these figures, then like I mentioned, the evolution of your turnover is important, the evolution of your gross margin is important. What about increasing or improving our EBITDA, or even the bottom line? In this example, which is a very trivial example, with a turnover increase of 35%, we can achieve a increase on the bottom line with more than doubling the figure of 2020. In the P&L, we talked about costs. And what about costs? We have actually 2 different models in which we can categorize them. And here is the first one, where we talk about direct costs and indirect costs. Direct costs are costs directly tied up to the product or the service that a company produces. They can easily be traced to their cost objects, meaning that we have the link immediately to the produced product or service. Direct costs include, for example, direct labor, direct materials, manufacturing supplies, wages tied to the production. We see also that there are fixed costs, which are costs that are immediately in connection with the volume of products that we put into the market. And we have variable costs, which are different, and they are varying based and in function of the number of products that we put in the market. On the indirect costs, we also have fixed costs and variable costs. And for example, trivial examples are, for example, on the fixed cost, electricity and rent we have to pay, and on the variable cost, the marketing and finance and administration costs. A second model is talking about capital expenditures, or the Kpis, which is mainly the costs and the finances that we carry for our investment goods. Next to the Kpis, we have the OpEx, operational expenditures, and those are basically the costs that we make or that we have around consumables and services to be sure that we can operate our organization and our company. Bringing us to the second level of finance, or the role to play from a finance department perspective, is that next to the business support, we add operational skills, moving more towards adding more and more value to the company and to the management. Topics that we cover over there are profit improvement, cash flow management, lining up internal systems, which are providing us with adequate and accurate information that we can then put in reporting tools and report back to the business. If we talk about the three key financial statements, we had the balance sheet, we had the profit and loss statement or the income statement, and we had the cash flow statement. In the Hollywood movie Jerry Maguire, Tom Cruise gets literally the question of his client, which was an American football player, show me the money. So also for a finance department, for a CFO, and for a company, cash is king. The cash statement is like a wallet. You start with an amount on your bank account. You will add the cash inflows that you generate from selling products to your customers, to having returns on investments, or even have financial inflows. Then we deduct over there the cash outflows, which are mainly the purchases of your raw material and your production goods, but also the salaries that you are paying to your employees. This brings us to an end position, a cash end position, where we can see if we have sufficient cash or liquidity or money in the bank to continue operate as a business. This brings us to the last level from a finance department point of view on how we want to support the business better. And then this brings us to the strategic planning exercise, on which Serge already mentioned the importance in combining it with the OGMS model. In the strategic planning area, we are looking if, for example, with the eye on 2024, when we want to be world champion in the Formula 1 competition worldwide, if there is a need on additional strategic funding, or are there risks that we can identify, and how are we going to assess them, and how are we going to mitigate these risks? What about the implementation timetable? Is it, from a financial perspective, achievable to do this by 2024, or can we do it earlier, or can we move it, or do we need to move it a year further away? And then it could well be that there are strategic activities and exit planning exercises that we can do to say, okay, when we have achieved this objective, what are the next topics that we can pick up and move forward with? This is actually, as a strong financial business partner, we turn your your operations and ambitions into simple financial models and graphs. Actually, the principle is here, eat the elephant in small bites. So what we do is we provide the different department heads with templates and tools to make up their budget, to have that tool to be used in the future also, looking at your budget versus your actual figures to see if you're on track or not. Also to identify additional benefits and or opportunities. Again, like I mentioned, identifying the risk and what is the best way to mitigate these risks. And also do a bottom-up exercise where we are looking into the capacity we have to achieve our budget goals. Do we have sufficient people in our department? Do we need additional investment in machinery, etc., etc.? Last but not least, we always take the lessons learned with us into the future, and we list the assumptions that we take in building our budget. Fortunately, there are tools in the marketplace where we can help our department heads with to either provide us the information and also to visualize the information that they have provided and that they are following up month by month, quarter by quarter. In the movie The Wolf of Wall Street, Leonardo DiCaprio gets the message there are two keys to success. The two keys in success for us as a financial partner to the business is that we look at the information on a horizontal way and on a vertical way. So we do an horizontal analysis, meaning we look at the figures, KPIs and the ratios over time, and we look at also from a vertical perspective. And then we move into the solid domain of looking into ratios and KPIs. For example, vertical way, we look at the gross margin, we look at the net margin, we look at labor costs against turnover. In the horizontal way, we look at trends on what is happening with our turnover, the direct cost, the indirect cost, what is our contribution and what is the evolution of the contribution, and also how is our EBITDA evolving. In a detailed analytical way, we can do that per region or per market. We can do that per business unit or per product service line or per customer type. Next to the cost that we treated with our two models, direct, indirect, Kpis and OpEx, we also want to have a little moment to focus on the pricing. Studies have shown us that a 1% improvement in price could yield the profit improvement substantially, meaning that 1% increase in your selling price can have an effect of 22% on your EBITDA. So this is something not important to realize.
And when we ask customers what they value the most, well, then pricing is on the 6th place. So what they value the most is product range. Next to that, product availability and customer service. And of course, the relationship they're having with the salesperson is very important as well. So from a business perspective, you want to know what products are successful and which products are not. And to help you in visualizing this, we suggest to use this graph. On the x-axis, you have the turnover, and on the y-axis, you have the potential. And that splits your graph into 4 quadrants. The divest quadrant is the place where you don't want to be. And actually, ideally, you have all your products up to into the green corner. So what you do is you map your products. It could be per region, could be per market, could be per customer type. So there's different ways of mapping your products. You even could create a third dimension by giving the size of the bullet, by linking that to the gross margin, for instance. And then when you look at it, and when you're in the orange corner, where you have low potential but high turnover, well, that's fine. Just follow it very closely, whether you still will stay in the orange corner and you're not moving towards the red divest corner. The blue corner is an interesting one. It's the corner of high potential and low turnover. So there you will have to look together with the team. What do we have to do with these products to move it from the blue corner to the green corner, where you have high potential and high turnover? So it's a very interesting way to make this analysis. We recommend to do this. It gives you new insights. Is the red square always a bad place to be? No. Strategically, it could be even a decision to stay there. For instance, with trainings. Trainings, in many cases, cost money, unless you sell them, but in this example, it's a cost. And but it could improve the relationship you're having with your customer. So in that case, you keep the trainings. It's part of your strategic plan. It's a cost, but in another place, it could increase profit. Another reason why you could stay, why you could have a product in the red square is like what if you would decide to take the product out of the market, and a direct competitor would take this opportunity to put products in the market and start interfering with what they are doing in the market, and therefore it could be a reason to block this customer and stay with your product in the market, even though you're losing money. And that brings us to lesson 2. Everybody is finance, and everybody has to understand the impact of business on finance. And actually, in the Formula One, that is what is happening. And that brings us to our second question. Do you have a real financial partner who shares business ideas and who explains risks and opportunities? And if you say, yes, we have, then we have our second cup. So there's still one cup missing to win the race. And it's the third cup. And it's about agile decision taking. Because when we look at the world today, we see that the world is changing rapidly. Every day we have hundreds and hundreds new ideas. And every day we have decisions to take. And these ideas can be about new products, about new services, new markets. Or what if we change the production process? Or what if we go to another supplier? What about quality control? Or what if we build a new office or install new ways of working? So it's clear that we need some governance to organize ourselves and to make sure that we take the right decisions. And to help you, we recommend you to install the growth funnel. And the growth funnel is about splitting your project into milestones. So you go from one milestone, from one phase to the other, when you all agree. And when you all agree, it's not just one person, it's as a team. It's about the budget, it's going to be about the strategy, it's going to be about the go-to-market, everything. So when you want to go from one phase to the other, you need, well, actually there's four decisions that you can take as a group. If there's a go, it means that you're ready to go to the next phase. So that's easy, green light from everybody to move forward. But it could be recycle. Recycle means that you have lots of green lights, but there's some orange and red lights. So there's some work to do in the phase you're working in. Or it could be on hold. It could be that you're ready to move to the next phase, but there's another project that is more important, or you have to wait for the results of another project before you can continue. But it very well could be stop, and could be in the first phase, could be in the last phase. The idea is you better stop because you're spending money, and if you know that it's not going to work, then that could be the best decision. So I already mentioned governance, and we have 3 governance principles for your daily decision taking. So the first one is the one that I just mentioned. Build this growth funnel. It can be different per sector, but build this funnel. Do it together and use it as a decision model. Then secondly, plan regular governance moments. It's important that you do this on a regular basis, you get used to it, and you will see that it's going to be part of the daily process. And then, last but not least, track progress and report to each other. It's very important that everybody has the correct numbers, because otherwise you're not able to take good decisions.
It has been mentioned before during the webinar, if you can't measure it, you can't manage it. But today, we are living in a global digitization in the world, and every company that is currently operational is probably supported by ERP or IT systems in every business process. Where artificial intelligence is rising during these times, and machine learning makes its entrance smoothly, all brought together by robotic process automation, we as a company, as a management team, we are sitting on a mountain of data. And these data, it's also one of the roles from a finance perspective, is to be brought into the company and to the decision makers in an informative manner and format. If you look into which are the financial ratios that the finance department used to support the business whilst adding value, then we have 5 categories. We've got the profitability category, we've got liquidity, solvency, we have ratios on activity and efficiency, and we also have, of course, ratios concerning our market outside of the company, market positioning. If you look at this slide, then you see a bunch of ratios and KPIs which are there to be calculated and to be decided upon to take the next steps. Fortunately, we have business intelligence tools and Kpis that are available, seamlessly integrated with ERP and accounting systems. And we also have these available on a daily basis. Most of the time, these BI tools are integrated with the supporting systems, and the upload of the data is on a daily basis at night.
And also for marketing and sales, it's important to bear in mind that return on investment is there. And when we go towards marketing funnel, and in January we already had a separate webinar about marketing, then you will remember this funnel. It's actually the phases that you need to turn a prospect into a customer. And per phase, you can measure what a conversion is. So let's say that you start with a basket of prospects, and that correspond to a total turnover of a potential turnover of 100,000 euros. And then you will lose some customers during the process. You will get some new ones, but let's say at the end result is the potential customers, the prospects that you turn into customers, equals 6,000 euros. And finance is asking you or gives you a target of 18,000 euros. Then you know that, okay, you have to triple your efforts and have more prospects, or you have to do something about the conversion rates. And during this marketing webinar, we already mentioned the collaboration, or the importance of the collaboration between sales and marketing. Actually, today we're adding a third level, which is finance. And as Wim already mentioned, we have the business intelligence tools to help us also for sales and marketing numbers. So we can add widgets, and we can term them or define them as we want to, and help us making decisions and looking into it and see if you're on track or not to get our target. One of the 10 reasons why businesses fail was about bad location. So also here, we can measure per location what the numbers are. Are they good or bad? Do we have to close a shop or not? So we have all this data, so let's use it. And that brings us to the third lesson of this webinar. The daily decisions of your team lead you to your destination. Very important. And you know, a lesson is linked to a question. So here's our third question for you. Are you monitoring progress in real time? And are you ready to take the right decisions? And again, if you say, yes, we do, then we have 3 cups. And if you have the 3 cups, well, then you're going to win the race. And that's what we want you to do, of course. And that brings us to the end of our webinar. And we would like to repeat the 3 questions that we are asking you. So the first question, do you have a clear business plan?
Secondly, do you have a real financial partner who shares business ideas and who explains the risks and opportunities? And finally, are you monitoring progress in real time and are you ready to take the right decisions?
And that brings us to the end of the webinar. So we thank you all for joining us today, and we hope that it was very useful. And we're ready now to answer your questions.
During the webinar, we have received some interesting questions through the chat functionality. First question is concerning the BI tools. BI is great, but the data need to be good. So a lot of tools give garbage in, is garbage out. This is a very, very good remark. It is important that, for example, finance is the guardian of the data quality, and that we make sure that the data that we use in our reporting tools or in BI tools, that it's adequate, that it's correct, and that it also is published in a frequency that is aligned with the business. So yes, we need to be very careful that the source data of our management reporting is completely okay.
There is a second question about which stakeholders you need to include in the progress meeting. Well, it depends, of course, of the sector and the investment that you would like to do. But it's clear that management should be involved. This webinar is about building bridges between finance and the business. We had previous webinars about building bridges between sales and marketing. So it's clear that the stakeholders should be the people that will be involved and will have a direct impact of the investment. Depending on the phase you're in, it's also important to include specialists. Could be internal people, could be external people, could be like an engineer, could be like a logistic specialist. So actually, per phase, per milestone, you have a fixed number of people, and then sometimes it could be experts that you include, but it really depends on the sector. It really depends on the objective you're having with the investment.
Another question that we received is how to develop your plan for 7 years to come, and what would be your time horizon. Like we mentioned during the webinar, it's very important that when you start building plans and budgets on a yearly basis, that you have a strategic objective that you put in a timeline of 3 to 5 years. And not much longer, because we all know that the world is changing very rapidly. So if you start with a strategic objective in 3 years' time, max perhaps 5 year times, then you have, let's say, the focal point on which to build your budgets year by year, stepping closer and closer to your strategic objectives. It's also important that you involve people from within the business, so that they all can help develop these plans and also help define the strategic objective, and the consequence is that also most of the time you have a 100% buy-in from these people.
And then there's another question about KPIs. How many and which financial KPIs? Well, depends on the business and the sector. In general, we advise to have between 3 and 5 KPIs. We know that most CEOs like to limit the number of KPIs, and actually with 3 to 5 KPIs, that should be okay. As mentioned before, the source data, of course, has to be updated and accurate, because the numbers or what you measure should be correct. Otherwise, the conclusions will be wrong. And also, when you have your KPIs, you also will have to look at the PIs and make sure that you have correct numbers per strategy. But let's say on average 3 to 5 KPIs, of which 1 to 2 KPIs will be financial KPIs.
Another question that we received here: what are the positive consequences to be expected from the digitization of your finance department or other parts in the business? The consequence or the aims that we are looking for with the digitization in finance is that we can build around the principle that first of all we have a finger on the, let's say, on the topics, on the finance topics, and that we have also the principle that finance is looking forward together with the business, making sure that from a compliance perspective, the historic data and transactions are correctly recorded, of course, but the time will be available for finance to add more value to the business and to help strive the business forward towards the strategic goals that were set upfront.
And then there's another question about investments. How can I check or how do I know if my investment will be lucrative or cost effective? There are several ways to do it. There's several financial ratios. We shortly mentioned return on investment. That's certainly a way to have a look at it. The internal rate of return, knowing that between 12% and 28%, depending on the sector, is a percentage that is used in the business. Payback time, also important to have a look at how long will it take to get your investment back, but also on the longer term, how long will my investment be effective? Because of course you can have a higher investment upfront, but if you know that, for instance, the investment will last for like 10 years, then it could be more interesting than having a cheaper investment. So there are several financial ratios to measure, and also to make a decision. If you have the option to say, okay, we have 4 or 5 ideas, which one to select, is use these financial ratios to argument your selection.
The following question concerns startups. So the question is what to do with startups where we miss historic data and figures. Yes, indeed, it's very important that for a startup or even for a scale-up business, that we start with the business plan that we need to develop to understand what is the offering that we are going to bring to the market, and what are the financial resources we need to have to be able to start the business and to help develop it and towards the longer term. So, of course, historic data is missing, but then we are using the financial business plan to see how we are progressing from an actual perspective.
And that brings us to the end of the webinar. We would like to mention that the webinar is recorded and replay will be available shortly on the businessmarkets.com website. Thanks again, and hope to speak to you in the near future.